Is this the end of the step up in basis? Yikes, Sniffy Joe coming at us hard. And I've said a million videos, this is just laying the foundation for future tax issues you got to contend with. I don't know if it's going anywhere. It's not going anywhere this session, I'll tell you that right now. Could it in the future? I don't know. We'll see. So let's read what Sniffy Joe says here. All right, reform the taxation of capital income. There's two things that are happening here. Two things. All right. And one I'm okay with. The other one I'm not so much. Most realized long-term capital gains and qualified dividends are taxed at graduated rates based on the taxpayer's taxable income, with 20% generally being the highest tax bracket, 23.8% when you factor in the net investment income tax. Moreover, capital gains are taxed only upon the sale or other disposition of an appreciated asset. When a donor gives an appreciated asset to a donee during the donor's lifetime, the donee's basis in the asset is the basis of the donor. All right, so what that simply means, let me just draw it up here, is what we do is we say, I bought a property, it could be a stock, it could be a house, anything, for $50. It's now worth $100. All right, so it's now worth $100. I give that to Maddie. And she has a $50 cost basis. All right, that's our cost basis. So anything, that's the unrealized capital gain. Unrealized gain right there. All right, does that make sense? So because it's a gift, I'm gifting her my cost basis. All right, that's how it works. So let's keep going here. All right. Let's see. The donee's basis is the asset is carried over from the donor to the donee. Yep. There's no realization of capital gain by the donor at the time of the gift, and there's no recognition of capital gain by the donee until the donee later disposes of the asset. So again, Maddie does not pay any capital gain until she sells this property. All right. Hope that makes sense. It does make sense because I'm explaining it. If it wasn't me explaining it, it would not make sense. But because your old buddy Josh, it does. When an appreciated asset is held by a decedent at death, so in this case, let's keep going for a second. The basis of the asset for the decedent's heir is usually stepped up to the fair market value at the date of death of the decedent. As a result, the appreciation accruing during the decedent's lifetime on assets that are held by the decedent at death avoids federal income tax. Well, avoids federal capital gain tax. Anyway, so in this case, this is a gift. All right. When I die, though, if I give this to Maddie via my will, all right, when I die, my $50 cost basis, there's a $50 unrealized gain, but then Maddie inherits it here at a $100 cost basis. So I die. Oops. I'm dead. My daughter inherits this $100 asset, which I paid $50 for, and if she were to sell it the next day, she would pay no income tax or capital gain tax, none whatsoever, because of what's called a step up in basis. Step up in basis. She's stepping up the basis from my original basis to the date of death valuation. All right, that's how that works. Let's keep going because it's important stuff here, man. It's a wonderful opportunity for tax planning that a lot of people don't take advantage of, but they should. All right. Preferential treatments and so now we're going back to capital gains and long-term and qualified dividends. Preferential treatments on long-term capital gains and qualified dividends disproportionately benefit high-income taxpayers and provide many high-income taxpayers with a lower rate than many low- and middle-income taxpayers. Preferential treatment tax rates also disproportionately benefit white taxpayers. Oh my goodness. But what cracked me up here is the rate disparity between taxes on capital gains and qualified dividends on the one hand and taxes on labor income on the other hand also encourages economically wasteful efforts to convert labor income into capital income as a tax avoidance strategy. It's just so stupid, dude. I mean, literally. So by me taking the income I receive off my labor and deploying it into a capital asset, which has a qualified dividend or long-term capital gain, to reduce my taxes. It's not tax avoidance, it's tax reduction, or it's tax avoidance, you could say, if I leave it to my death. My labor income provides me a certain amount of capital that I can then use to buy assets. What do I do with those assets? Oh, I'm investing those assets. which are absolutely capital, not just capital intensive, but productive, Sniffy Joe. It's insane, dude. They're saying right here, wasteful efforts to convert labor income to capital income as a tax avoidance, economically wasteful. It's just so freaking stupid. It's actually converting labor income into productive income, i.e. investing in startup companies, investing in my own business, investing in anything I want to do. It's freaking idiotic. Under current law, because a person who inherits appreciated asset at death receives a basis that is equal to the fair market value of the decedent's death. Yep. Appreciation that had accrued during the decedent's lifetime, that'd be me in this case. I'm the decedent. All right. So there I am. Got my little things like that, old cartoons. I'm dead. My little hair. I don't have much hair left apparently. And so my appreciated asset is what Maddie receives. All right. So because equal to fair market appreciation that had accrued during the decedent's life is never subject to income tax. In contrast, less wealthy individuals who must spend down their assets during retirement pay income tax on the realized capital gains. See, this friggin' just pisses me apart, my French. You ever heard of zero in the two tax brackets, Sniffy Joe, where there is no capital gain tax? You ever heard that? If you're married, filing jointly, you can make roughly $130,000 of gross income and pay no capital gain tax. It's just idiotic. I mean, it's just so stupid. All right, let's keep going, though. I mean, I don't know what happened to the Democratic Party, why they just, DEI consumes them forever. It's crazy, because Sniffy Joe is the biggest racist there is. He's just as racist as freaking Robert Byrd, the Sheets Byrd, literally a Klans member for the Democratic Party. I mean, Sheets Byrd, remember Rush Limbaugh used to call him Sheets Byrd. Crazy. All right. In contrast, this dynamic increases the inequity of the tax treatment of capital gains. No, it doesn't, you freaking idiots. In addition, the preferential treatment for assets held until death produces an incentive for taxpayers to inefficiently lock in portfolio of assets and hold them primarily for the purpose of avoiding capital gains tax on appreciation, rather than reinvesting the capital in more economically productive investments. See, this is just so freaking economically illiterate. I'm investing my money in a startup, Amazon, we'll just use that, and another startup, Pets.com. Pets.com goes kaput, Amazon keeps going. Sniffy Joe wants me to sell my investment in Amazon, right? So that way I can invest it in something else. But guess what? The investment in Amazon is still productive. It's still making money. Oh, that money I make, if there's an income stream, i.e. a dividend, I got to pay tax on it. But guess what? Amazon is doing what with the proceeds of my investment? They're growing the company, which is doing what? Hiring more people, paying more income tax, paying more Social Security FICA taxes, paying more real estate tax, you freaking fools. It's just really, it's insane. So for me saying, no, I don't want to sell my initial investment in Amazon because it's still productive to me. This is so stupid. All right, let's see. More of the distribution of wealth is growing increasingly. That's true. Reforms to taxation of capital gains and qualified dividends will reduce economic disparities among Americans and raise needed revenue. So it's all about this. We need more money. Okay, well, we need more money, yet we just gave $60 billion more to Ukraine. Well, because if we don't do it, Putin will be over here. We'll all be speaking Russian in no time. I literally have people on my channel who say that. Josh, don't you know, if we don't stop Putin in Ukraine, they'll be in France in no time. It just is mind-boggling to me. It's insane. And I say, okay, so when 60 billion more doesn't stop, what's going to stop it? What's going to stop the domino effect, essentially? The domino effect of Europe. American troops? Just this hatred of Russia is insane. And I'm the biggest anti-commie guy there is. All these other people talk about World War II. I'm like, Nazis, that doesn't bother me. I mean, I don't like Nazis, but I'm like, that. I was reading about commies taking over from Alexander Solzhenitsyn. How would they say that guy's name? The Gulag Archipelago, August 1914. I've read 1 million books on the commies takeover. It's insane. All right, let's keep going. So here's a proposal. The following changes to the current law. Long-term capital gain and qualified dividends of taxpayers with taxable income of more than $1 million would be taxed as ordinary income rates. I've been saying that for years. If the Republican Party were smart, and they're not because they're paid to be the Washington Generals, they'd say, hey, We're just following up on Sniffy Joe's tax proposal to raise long-term capital gains and qualified dividend rates on people with $1 million or more of income. But instead of just using it for the general fund for DEI purposes and to send to Ukraine, we're going to use that money to shore up Social Security. I'm all for that, but they're not because they're just going to waste it. I would say no. This money is almost going back to Al Gore lockbox. This money is specifically used to shore up Social Security and Medicare. That's what I'd say, but the Republicans won't. Anyway, so that's what they're going to do. The proposal would only apply right here. So if you have $1 million or $500,000 if you're a single taxpayer. So if you have $500,000 as a single taxpayer or $1 million as married filing jointly, you would lose a preferential treatment of qualified dividends and long-term capital gains. Under the proposal, the donor, your old buddy Josh, or deceased owner of an appreciated asset would realize a capital gain at the time of the transfer. The amount of the gain realized would be the excess of the, so again, this is pretty simple to say. The amount of the gain, when I give this money to Maddie, all right, when I give that money to Maddie, the transfer. Well, I guess this is the case they're saying at the death. Never mind. So we'll go back to here in just a gift for a second. The donor or deceased owner of an appreciated asset would realize a capital gain at the time of the transfer. The amount of the gain realized would be the excess of the fair market value over the cost basis. The gain would be taxable to the donor, and the donor means I'm still alive. So in this case, we've got a gift or a death. Either way, my $50 unrealized gain, when I give that property to Maddie, either if I'm alive or if at death, would be taxed as long-term capital or as income tax. I'm sure it's capital gain. It'd be taxed as capital gain. And then we go up here, and this is where the problem with this proposal is. If you make more than $1 million, it'll be taxed as ordinary income. You see, that's the problem there. That's why I don't want to get rid of the step-up basis, because we don't want, now if you just inherit a property for $2 million in, I don't know, freaking Los Altos. So my grandparents bought a house in Los Altos, California, I don't know, in 1967 or something like that. No clue how much. We'll say $50,000. When that sucker got transferred or sold at death of my Grammy, it's probably $2 to $3 million is what that house is worth, or something like that. All right, so essentially the long-term capital gain, the capital gain is long-term capital gain, which is now going to be taxed as ordinary income because it's over $1 million of income. Yeah, that's not good. And if you're living in a blue state, this is affecting you big time, because that's where the property values have gone up the most for sure. The gain would be taxable income to the donor, again, I'm the donor, or the donor's estate on the federal gift or estate tax return on a separate capital gains return. All right, let's keep going here. Together, the proposals would increase the top marginal rate on long-term capital gains to 44.6. Yeah, 100%. When you got net investment income, a 39.6% tax rate too. And that's where everyone's like, oh, it's a nothing burger. This doesn't affect that many people. Well, it's going to affect a lot of people. In of itself, that part doesn't bother me. It's getting rid of the step-up basis that really ticks me off. So right here, for example, a taxpayer with $1.1 million in taxable income, of which $200,000 is preferential capital gains, who would have only $100,000 that would be subject to the income tax as opposed to long-term capital gains. Second, transfers of property into and distributions in kind from a trust other than a grantor trust as deemed to be wholly owned by and irrevocable by the donor would be a recognition as well. All right, so removing property into a trust or out of a trust, that would be the same kind, and revocable too. This isn't irrevocable, this is revocable. If the transfers have the effect of a gift to the trustee, the deemed owner of such revocable grantor trust would recognize gain on any unrealized appreciation of any asset distributed from the trust to any person other than the deemed owner. So again, we're making a gift from the trust, or distribution, if you will. It's not even just distribution of net income, distributable net income. We're giving money from the trust to some other entity. That be recognized as a gift and be subject to the realization right there of the property from the fair market value of the capital gain. All of the unrealized appreciation on assets of such a revocable grantor trust would be realized at the deemed owner's death or any other time when the trust becomes irrevocable. All right, so again, you're going to have an unrealized gain. There's no more step-up basis. It's realized at the date of gift or the date of death, the capital gain, which is going to be a massive sale of property like you've never seen, because people say, I don't have the liquidity. This would be a boom for life insurance. I don't have the liquidity for any of this. Where's the money come? Well, I got to sell grandma's house. I don't want to sell grandma's house. I want to save it because I love the house. I have many memories there and I want to keep it. Nope. But I don't have $400,000 of income to pay the recognition of the capital gain. Sucks to be you. So where does the liquidity come? You only have one choice. It's this freaking sale of the house. That's it. It reminds me of the old estate planning days. I don't want to sell dad's business. You have to. But he doesn't have liquidity. I got to pay the estate tax. Well, you got to sell the business. I don't want to sell the business. You have to. How else are you going to pay the estate tax? And you sell it at a fire sale because everyone, the buyers are freaking like piranhas. They know they have no liquidity, and they're going to give you, 80 cents on the dollar bid for sure. And this is where life insurance would come in to generate that immediate liquidity. So the life insurance people are going to love this. Now let's keep going. Certain exclusions would apply. The transfers to a U.S. spouse or a charity, again, so this unlimited exemption to your spouse, which is fine. Charity would carry over the basis of the donor. So again, the charities, this is why we just got to get rid of charitable deductions. It only affects rich people. The proposal would exclude from recognition, this is where it gets important, any gain on non-tangible personal property such as household furnishings or personal effects, your baseball card collection. I'm sure your firearm collection, Snippy Joe, will allow you to transfer without tax. The 250 to 500,000 exclusion is still available too. So it's above and beyond the 250 single taxpayer and 500,000 exclusion for married taxpayers on selling of your primary residence. In addition to, so here's where it gets, it's a $5 million per donor exclusion from recognition of other unrealized capital gains. So this exclusion would apply only to unrealized appreciation on gifts to the extent that the donor's cumulative total of lifetime gifts exceed the basic exclusion of $5 million. The exclusion would be portable to the decedent surviving spouse on the same rules that apply currently to a portability of estate tax, so resulting in $10 million and would be indexed for inflation. The recipient's basis in property, whether received by gift or by reason of decedent's death, would be the property fair market value at the time of the gift or the decedent's death. So basically what they're saying, I don't think I have it. They're saying we're going to allow a $5 million exclusion. So it's not just for everybody. It's got to have $5 million exclusion before you're subject to the getting rid of the basis. Yeah, and if you think it's going to stay there, you're freaking nuts, dude. You're nuts. So I'm surprised by this, man. I'm surprised that, the mortgage people, the National Association of Home Builders, they'll scream bloody murder, as rightly they should. We don't want to get rid of step-up basis. Step-up basis is a wonderful, easy-to-use system to reduce your total taxes and make it just a seamless transition of an estate as well. Because it's just fair market value at date of death. That's it. And that's how you validate it, fair market value at date of death. All right, so Maddie inherits this. She didn't have to generate any liquidity in which to sell the asset at a reduced price at a fire sale. She just keeps it. If she wants to sell it, she can, but she can sell it at her discretion as opposed to Sniffy Joe's. This is a big shot across the bow, man. Shot across the bow, something like that. And I would be I tell you, again, this is not coming to law. It's just not. But this is what they're thinking, and they're telegraphing. Be advised to start your estate planning. Don't just, I don't have an estate big enough to worry about it. You don't now. You easily could, though. Right. I know it's a long video, but love to hear your thoughts. God bless. And don't forget to subscribe if you haven't already. We'll see you.